welcome to the podcast, everybody. Thank you for joining me. It is 3 o'clock Central Time, 4 o'clock Eastern Time. The stock market is closed, and had an update today after the expected ECB QE announcement. Kind of been leaked the last few days, and it was actually a little higher than what people anticipated. So Draghi came through with his promise of wanting to do QE. So they're doing their bond purchases, 60 billion euros per month. He did give an end date, and this is simply passing the baton, isn't it? This is Janet Yellen saying, we're not doing it anymore, but you do it. So again, this market is being dominated by central bankers crushing their currencies, printing more money, et cetera, and unfortunately, there's a disconnect because the market celebrates that and rewards that. And so what do? They continue to do that. And our market was no different. Our stock market was up today in the U.S. The Dow Jones finished up 265 points, or about 1.5%. NASDAQ was up 78 points, or 1.67%. And the S&P 500 was up a little over 30 points, 1.5%. Russell 2000 was the strongest, up 21 points, or 1.8%. Interest rates were up today. Gold was up today. Emerging markets up today. One of the sufferers was utilities, which I continue to be bearish on. But let's get into the overall stock market here. So here's the S&P 500. You can see up about 1.5% today. Pretty strong day overall. You'll notice here that we continue to be in this little channel. Now, we did go out of it, of course, during October, and I've told you about that. When we broke the 200-day moving average, we broke out this channel, but you can see it's gotten back into it. So, of course, the next logical thing here is for this to get back up to here and then start to head back down. I continue to see signs of complacency in this market, and I continue to see signs of some stress overall. So even though you get these up days, don't jump back in there thinking the coast is completely clear. We're starting to see volatility pick up, and it's starting to I haven't seen this much volatility the way I measure it since the end of 2012. So we're talking over 2 years of this kind of lower volatility, and I think it's starting to pick up. And we also have these markets that fall a little bit, and they're not falling dramatically, but we see these fall, and those are coming sooner and sooner together. So again, we're not out of the woods here if you're bullish just yet. I would say this, that it's easier, for me anyways, it's easier to stay invested, and for the most part stay invested and keep your strategies the way they are, but have a strategy so that when it's time to sell, you can do it. In other words, you can choose right now to say, I'm going to get out. And if you do that, if you say you're getting out right now, you're saying this is the top. And I don't think any of us know that, right? We don't know that. And so, but if you get out completely, that's what you're saying. And so what's better for me anyways is to obviously determine what type of volatility you want to put up with on a daily basis, and then stick to a strategy so that you can move forward. So there's a lot of stocks moving right now. I think one thing that's interesting is we do know that oil continues to fall, down about 2.5% today, yet the stocks are holding up very well. One of the stocks that I own in my aggressive strategy is Baker Hughes. Came out with really good earnings, and you can see it's been moving sideways for quite a while here. In fact, Baker Hughes is at the same level it was back in October. Okay, so they obviously got bought out by Halliburton, had that big spike, but Halliburton bought them. One of the smartest things they've done, Halliburton bought them in cash plus stock. So if they'd bought them all cash, the stock would have stayed up here and never gone down. But because they bought them in cash and stock, it's a ratio. So as Halliburton has fallen, so has Baker Hughes. But you can see it's actually held up rather nicely, moving sideways really for the last several weeks and threatening to go above its 200-day moving average, even though, and we'll take a look at USO, which is oil ETF, even though USO continues to fall. So a great pairs trade would have been short oil, long some of these stocks. Of course, when you get stocks in the E&P space, they're going to be extremely volatile, and we saw that today. So again, some of this has to do with, we know about the Swiss franc. We talked about that on the radio show. If you want to invest in the Swiss franc itself, here's the ETF to do so. Had a jump of roughly 21% from top to bottom here. and this caused all kinds of disruptions around the world. Money is now moving differently than it was before. You saw the euro get crushed today, and you see interest rates in our world start to move back up. So if you're short treasuries, then the last few days have been pretty good. And who knows where this can go? It could turn around. We do know that if the stock market gets more volatile again, and that volatility stays here, and the stock market starts to go back down, people are going to continue to pile back into treasuries. But do we get a move back up into this range up here of this, let's call it 2 to 2.5%, and that may be likely, and maybe we just keep playing this range. Maybe at this point right here you go in and buy treasuries. I don't know if it'll make it that high this go around, but I do know that owning treasuries at some point is going to be a really bad trade, and all those people who are in safe bonds are going to be in risky bonds at some point. And we already know that depending on where you are in the bond market, you're having some trouble, right? Junk bonds, for example, have been falling consistently since summertime. Lower lows and lower highs. That's what these are. And that's continuing. So, junk bonds were already selling off, which is a concern for me. And then when you add energy on top of that, the energy junk bonds are going to have a lot of stress. So that's a big concern. We obviously do know also when you talk about the Russell 2000 has been not doing very much, even though the stock market went up to new highs. The Russell's been moving sideways. So those are a couple concerns. Here's the volatility index. You can see here we're getting these spikes that are coming a little more frequently now, these VIX spikes. And so, again, these are all things that are telling me that there's a little more volatility in this market, a little more stress. And again, if you don't have sell disciplines, you could get hurt at some point. But while it's going up right now, while the market is celebrating QE and central bank planning, you can enjoy the ride. That's fine. But again, just be careful. That's all I'm saying. And just have a strategy in there. Of course, emerging markets, I'm bullish on emerging markets. I think emerging markets right now, again, offer a great value relative to the U.S. And I know a lot of smart people are making that bet. And I think over the long run, I don't know what's going to happen in the next couple months, but I think the big picture here, this is going to be the next place. It could even be, a lot of these European areas. But emerging markets right now offer the best value when you look at the yield you're getting, when you look at the growth, even though the growth is slowing. But when you look at the growth, the yield, and how much you're paying for these stocks, to me, they look good. You can see this kind of bottoming process they've had here, and we've been moving off of this each time. Unfortunately, it's also been hitting the top. So we're kind of stuck in this, this range here where it's been essentially just, hitting the top, hitting the bottom. And now we're kind of in the middle. So there's not a big edge here. I own a little piece of this as a core position, and I think this is something that I'd want to keep for a long time because, again, if you go back and look at what's happened over the last, several years, emerging markets have underperformed the U.S. stock market quite a bit. Let's jump around here. Again, I am jumping around. I want to point out something with gold. Gold definitely looks like it's breaking out. I just want to warn you of something here, and this happened last year. If you notice what happened in January last year, gold got off to a great start. And if you kind of zoom out, you would say, well, it looked like it was starting to turn the corner here. It started to all these moving averages starting to flatten out. And then gold suffered the rest of the year and ended up making lows in October. Now it's doing the same thing. So I'm not saying that this isn't a turning point for gold. I would just be careful. I would much rather see gold come back down to here and then make another move up because what happened last time was it moved straight up. And this is a big move, by the way. Look, in January of last year to March of last year, gold went up 17%. A lot of gold stocks went up 30, 35%. But if you didn't sell them, you lost all that money over the next several months. It could be the same case this time. So watch it. But certainly if gold can hang around, maybe back and fill a little bit, then that we may get more constructive on it. But right now, I'm still not real bullish on gold. I think some of this is having to do with, obviously, the Swiss franc, and there's some initial adjustments. But let's see if it continues. If it does, fantastic. Then at some point on a pullback, we would buy it and try to ride that a little bit. But right now, to me, this looks like an early of the year move, kind of like we saw in January of 2014. And lastly, here's the Dow Jones, and you can see I've tried drawing these boxes here where it was in this box Now we went up to another level, another box. So 18,000 is the test for the short term. We may get up there, but what we need to see is these rallies. We need to see the quality of the rallies keep building on themselves, and I've seen the quality diminish the last few weeks and less stocks participating. So again, there's no doubt in my mind we're in the maturation process of this bull market. Are we in the 8th or 9th inning? I don't think so, but I think we are in the latter innings of this bull market, and that just means you're going to be more selective at times, and it's also going to mean that you have some trades on and take profits. And I lastly think you have to have a sell strategy, because it's going to turn to a bear market at some point, and when it does, you need to be prepared. I did tell somebody yesterday, though, here's the thing, because of central bank planning, and we saw it today, there's just as big a risk that the stock market goes up 20% this year than going down 20%. Some of you may think there's no way it's going up anymore, it has to go down 20%. There's just as big a risk as it goes up because of the central bankers and the central planning by them doing these quantitative easing. What if the Fed comes out and says we're not going to raise rates in 2015? The market will go up another 500 points easily, right? So they have that power, unfortunately. At the end of the day, long term, it's all based on fundamentals. Short term, it's based on some of the central bank planning and popularity of this stock or that stock. So just be careful of that. That could we be in this topping process? And I think the answer is yes, we are in the topping process, but we may be in the early innings of the topping process. Okay, so we were topping in early 07. Many of you have been listening on the radio since that point, or podcasts since that point, and we were talking about that hey, this isn't a topping process. And then of course 08 came and down it went, but it took a while, didn't it? So I'm just telling you, there's some yellow flags out there right now, and it's not all coast is clear just because the market's up. But I do own stocks. I'm happy the market's going up, but I'll also be happy when I take profits at some point and I'm sitting in cash or short the market or whatever, because my systems are playing out. And again, that's why you have to have systems so you don't get juked out of the market too quickly. All right, guys. Hey, don't forget twitter.com @CarlEggers is my handle. We're on Google+, iTunes, Facebook, all those things, and we do our weekly radio show. And if you're in San Antonio, it's AM 930 at 7 a.m. every Saturday morning. You can also go on the website at eggerscapital.com and get the archives on the right side where the microphone button is. And keep the questions coming. Love them. Talk to you soon, guys. Bye-bye.